You're the owner of a small business, which means you're also the tech guy, and HR, and personal assistant, and head honcho, and intern. You could use another pair of hands, like the experts you'll find at Verizon Small Business Days, April 21st through 27th. Get a free tech check, special deals, and more. Call 1-800-483-4428 or visit verizon.com/smallbusiness to book your appointment. Verizon Business.
Reality radio for a really great future. We're talking real money.
Hi, welcome to Talking Real Money, the radio show that becomes a podcast, and the podcast that just keeps giving advice about money over and over and over again. I'm Don McDonald, along with Tom Cock, who's hanging out over there, and we are here to help you. Just give us a call at 855-935-TALK, 855-935-8255. We, unlike everybody else out there, or at least most everybody else, we're going to tell you the truth about money. Everybody else, okay, maybe they don't flat out lie, but they stretch the truth. They obfuscate a little. They, smear a little Vaseline over the truth to make it blurry.
And one of those areas where there's a lot of smearing going on is about this really important part of saving money.
Yeah.
Is then living off that money in retirement. And people, I get it. It's a struggle, right? I save something. How do I take it out? What's the best way to have it invested once I retire? And this is where people lick their chops who are selling this product called annuities.
Yes.
And they're very good at selling them.
Because they mislead people. This article from Financial Advisor magazine, talking about annuities. What's the headline of this thing?
Generating retirement income with annuities.
Yeah. So they quote a guy.
This is insider. This is a industry piece.
They quote a guy, Kennedy. Guy named Kennedy. Get this, a guy named Kennedy at Lincoln. Kennedy's at Lincoln.
Hey, that's good branding right there.
Right there. Love it. And Kennedy at Lincoln says, quote, today, our flagship annuity benefit is offering an income rate at age 65 of 5%.
Now, what does that say to you? Let's stop right there, because I think what people hear is, I'm making 5% a year on my money.
Bingo!
No, you're not making 5%. They're giving you back your money.
Right.
And a little bit of growth.
Right.
But that's what you're getting back. It's not how big the pot is growing. No.
Fixed annuities right now, the yield.
How much?
The actual yield on fixed annuities, the highest one I can find today is 3%, not 5%.
Which is pretty good, actually, when you consider the 10-year U.S. government bond is at 1.4.
Right, but that is a 10-year annuity. You're going to get penalized if you get out before 10 years. And the other thing is, no matter what they say, these rates, these 3%ers are from B+ rated insurance companies, not the best.
So you're trusting them to give you the money back with the interest.
Yeah. And the fact of the matter is that in a severe economic crisis, insurance companies can and have gone bankrupt in the past.
Didn't we all invest in a company called AIG in the last crisis to make sure that they could meet their obligations for a period of time?
AIG nearly took the economy of the world down. If we hadn't bailed them out, that company was so big and so dishonest, in my opinion.
We'll see about that. But here's the thing.
They didn't tell the truth all the time. They weren't 100% safe.
True. No, it's not 100% safe. But this is the question of the hour, because I think what people are saying is, look, if I put this in bonds, I'm not going to make enough over time to pay myself and to have this grow in a way that it won't disappear, right? And what they're saying in this article is, look, the difference between what you're getting paid in bonds and what we're giving you is, 2.5%, 3%, all this, it's malarkey. But what do you do, right? What do you do when you get to retirement?
Well, I'm going to add one other little interesting twist to all of this. For those of you thinking, well, 3% is pretty good. Remember, I said that's from a B+ rated insurance company. What's the yield on an annuity from an A++ insurance company? The highest rating you can get, the most financially stable, the ones who are most responsible, who behave better. What do you guess the yield is on an A++, Tom? Ballpark it.
I'll say 3.
Try 1.1 to 1.6.
Wow. Oh, wow. Okay. Well, 1.6.
That's the difference in the risk. These lower rated insurance companies don't mind taking a bunch of risk with your money. The higher rated ones aren't taking that risk with your money and therefore aren't paying you much more than treasuries. Because there's no magic formula.
Yeah, I don't care if your name's Kennedy or Lincoln or whatever it is. This is not very presidential. But here's the way to look at this. I think is what the annuity company is really the middleman. And this is a quote I'm stealing from Rick Edelman, that you're giving them the money. They're investing it in stocks and bonds, and they're giving you back part of your money at a lower rate.
Right. Which actually, if they're investing it safely, should be closer to 1.1%. Than 3%, because there is nowhere they can go and get 3% safely, so you know they're taking risk.
Tom and Don are talking real money.
Tom and I created Vestory to help everyone become a better investor, even those who will never be clients. Let one of our advisors help you start your financial plan or solve a money problem free with no obligation or high-pressure sales pitch at Vestory.com, Vestory.com.
For your real life and real future, Tom and Don are talking real money.
855-935-8255. Call, we'll answer questions. We like doing that. We hope you will call us. 855-935-TALK. We want to talk about money with you and help you make more by making it make more sense and not getting ripped off in the process.
Yeah, and one of the places you see a lot of the rip-offs are annuity products, because these are products that people hear the wrong thing. I'm getting a guaranteed 5%. No, that's how much they're taking out of your portfolio. But your question is, okay, well, then how do I supply my income in retirement? I still think, for me, the best way is to build a proper portfolio, risk-adjusted for how much volatility you can accept, and then rebalance that every year. Take the money from the things that were the winners, put that in your pocket, go back to your correct percentages, pay yourself that way. I don't believe in high dividend paying stocks. I don't believe in taking distributions from those stocks. I would reinvest those. I would rebalance the portfolio, live off of that money. And it's been successful. I know there's people that argue, well, the 60-40s doesn't work anymore because interest rates are so low. It's still working today. Let's put it that way. So I'm going to say this until it doesn't work for a long period of time, not just this year, for example. Doesn't make sense to me.
I really need everybody to hear this again. The highest rated insurance companies in America, Guardian is one of them. Guardian is A++ rated. They have a 4-year annuity paying 1.1%. New York Life, another A++ rated company. You know them, big company.
Sure.
A++, a 1.6 rate on their annuity. So when somebody's telling you 5, that's not possible. What they're doing is giving you back some of your principal. Okay, and it's important to know that now because I've got a question that was sent in to talkingrealmoney.com. And it's a question that I had to do a little reading on, and you're going to I'll share some of that with you. It's, hi, Tom and Don. Been listening for years. You two are absolutely fantastic. Please keep it up. I've been hearing ads for this lately. I have too. Curious about your thoughts. And the ads are for Life Rates of America. I've heard their ads, radio ads. And he wants us to comment on that. So I went and...
Okay, what is that? I don't even know.
Life Rates of America. They call themselves a financial services company. In fact, they're an insurance agency. They're an insurance agency. Yeah. And listen to this. Listen to this. As you know, banks pay very little interest. You can get a CD alternative account from high-rated insurance companies that pay between 3.5 and 4%. And the interest is tax deferred. Well, we just discovered the best is 3%. So right there, we have a bit of a lie or a fib. Because they're not getting 4% on a safe insurance policy. Now, let's go on. Other good options are growth accounts. Growth accounts. I'll tell you what those are in a minute. Which give you the potential market performance, but without the risk.
Oh, I'm always looking for that.
You know what that is, right? From an insurance agent? What is it?
I don't know.
Indexed annuity.
Oh, yes. There you get returns like the market with none of the risk.
These growth accounts have been averaging from 4 to 7.75% in recent years. But in the last 18 months, our clients have been receiving as high as 17.7%. How
can they even say this stuff?
Because it's insurance, and that's the problem. Oh, and by the way, they say these are safe and 100% guaranteed. There are no fees. Another big, fat lie. And by the way, Life Rates of America, I'm calling you out. I'm telling you, I'm telling people you're lying. Would you like to come on and defend yourselves and tell us the truth about your annuities? Please, if somebody's working for Life Rates of America and you want to tell us the truth about your policies, you want to tell us what your commission is? Want to tell us what the surrender fee is? Want to show us actual examples of somebody making 17.7% on an indexed annuity? Sure. Because I know better.
What are they going to do? Drop by?
They can call us. They can go to talkingrealmoney.com and send us a note. I will have you on the show. I'll give you the better part of an hour to defend yourself if you think you can defend this kind of lying.
I'm glad I haven't heard their ads because I probably steer off the road into a tree.
We do not charge fees.
That's my favorite one. We do this because we're just nice people.
But we've actually read your prospectuses, you guys. Yeah, we've read the prospectuses. Yeah. We've read the disclosure statements. The one thing you know your clients aren't going to do because they're massive tomes that will bore even the smartest and most interested among us to tears because I've been bored to tears by them. And we know that you charge commissions between 7 and 10% of the initial investment. We know you do that. We know that the average annual return for indexed annuities is more like 3 to 4%, not 7.75. And yet
by the way, they will run around and say these numbers.
Yeah.
People will buy this product because all they hear is the G word. I'm guaranteed not to lose money.
Yeah.
And I might make 17% like the guy did last year.
And let me tell you, Life Rates, you know what the best defense against defamation is? Truth. The truth. And I'm telling you guys in the insurance industry, you know what the truth is. What you're doing is twisting and bending the truth, which and it's called lying. It's lying. Don't trust these people. Do not trust them. Make them verify it. Make them show you actual numbers from somebody's account. They can black out the names, but make them show you actual returns.
Yeah, that would be.
Make them put in writing, I received no money for selling this to you.
Oh, nobody can sign that because that's a pile of you-know-what. Of course they make money. They're making a living.
And they're lying because there's no such thing as a high return with no risk. Just not possible. Period. One of the best things about turning a live radio show into a podcast is that you can do after the show updates. And that's what this is. This is an update with new information I've gathered about Life Rates of America. Oh my gosh. I don't know how they stay in business. I'm truly baffled. It's amazing. So here's the deal. When you search for Life Rates of America on Google, you get an address that is on Eagle Road in a really tacky strip center on Eagle Road. But if you look, you see that location is permanently closed. Permanently closed. So I went back to Life Rates of America website to see what their address is there. It appears now they've moved 7 blocks further up South Eagle Road in Newtown, Pennsylvania. And but I love the internet. So I look it up on Google Maps, and I find another strip mall. And I'm going down the strip mall, and I go, well, let's see, there's a cabinet store, there's a Progressive Insurance Agency, there's a Smoothie King, an H&R Block. Wait, I just skipped over their address. Wait, 21, wait, their address is for a place called the Parcel Place Plus. What do they have at parcel places? Like, UPS stores and the like. What do they usually have at those? They have boxes, mailboxes that give you a street address. So they have a street address, but it's a Parcel Place P.O. box. This just doesn't, boy, I got to tell you, this business does not feel totally legitimate, does it? It just feels a little shady. Yeah, this just reinforces my opinion of them. Now back to our regular program. So I hope that told our correspondent what I think of Life Rates of America.
By the way, the phone lines are still open if you want to call and tell us that. 855-935-TALK.
855.
Actually, you can ask us other questions.
Yeah, we don't have to talk about annuities, but I'm so glad that it came up today because it's been a long time since I've been able to spleen vent about them.
Well, you're somebody who actually sat down, and you alluded to this. You went through the actual product to see what people will make because you're limited. You get a certain percentage of various indices, right?
Right. Up to
that's
caps, and you only get a percentage of it. You get a participation rate up to a certain cap. You don't get the whole return of the market. You don't get the dividends. No dividends whatsoever. It's not an index. It's a made-up market tracking thing. And then they make them up. They've got these weird things that don't even come close to any index you've ever heard of. It's all a con.
Tom and Don are talking real money.
Want a free copy of my book, Financial Physics? Well, go download it right now at vestory.com, vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Hey there, welcome back. I'm Don McDonald. 855-935-TALK is our phone number. Did you hear the sound? I did. I heard the email going to you. It went, shh.
Wow.
Well, because see,
I just got it.
My computer's hooked up to the sound thing. I can't remember what it's called.
I don't know what that's a worst explanation.
The tie line. The tie line.
Okay.
Tie line.
Yeah,
my computer's hooked up to the tie line, which means I can do things like this.
And now, ladies and gentlemen,
Talking Real Money continues.
In a world where no commissions are paid to your insurance agent, in a world. No.
All right, we got another question. 855-935-TALK is the number if you want to call them in, but we got questions that people send in. They send them in all the time to talkingrealmoney.com. And there are 2 ways you can send them to talkingrealmoney.com.
No.
Yeah. You can type them, or if you have a mic on your computer, like I do, and I also have this, you can speak them and record
How many people do the speaking thing? It's
a lot.
Weird.
A lot. We had one last week. We had one on the podcast.
Oh, that's true.
Yeah.
Yeah. Okay. All right.
Yeah.
It's unusual. Usually people type them. They're more comfortable.
1 or 2 a week. We'll speak them in. Yeah. I think with Zoom, good computer mics are becoming more and more prevalent.
Well, that may be, but people are kind of shy about leaving a voicemail instead of typing it.
But we get phone calls.
Most people. All right, that's true.
It's about the
we used
same.
to.
All right, here you go. I hope you can answer this one. I hope you can answer this one because
okay.
I don't deal with clients every day like you do. Yeah. So
thankfully for the clients.
I'm hoping because I don't.
Please. I'll go out in the hallway and find somebody who does.
I know this part.
Ahead.
Hi, guys. Great show. Oh, thank you. My 27-year-old son is an expat teaching English in Japan for a non-U.S. company.
Okay.
He told me he started getting into investing by investing, and the guy put it in quotes. Thank you for putting it in quotes. He told me he started getting into investing by opening a Robinhood account. He used a VPN, a virtual private network, to get around the sign-up, so probably not kosher. I told him
not kosher.
I told him that's a bad idea. I got him all excited about buy and hold strategy using low-cost, globally diversified index funds. I convinced him to invest in VT, so he tried to open a Roth IRA at Vanguard. But due to him residing outside the U.S., he ran into a roadblock. Are there U.S. firms that will allow an expat living in Japan to open a Roth IRA? We are aware that he must use the foreign earned income credit on his tax return in order to be able to contribute. Well, no, but that's to be able to contribute, though.
Yeah,
he can contribute to an IRA as an expat. He could just purchase VT through Robinhood, but won't get the tax advantage of a Roth.
Can I make a suggestion here? It's a whole lot easier than all of this.
Yeah.
How about just setting the money aside, and then when you come back to the United States, then you open the account and make the purchase?
Or if he's not going to come back anytime soon and he's already got the Robinhood account, what's wrong with just buying VT in the Robinhood account, because VT doesn't distribute gains?
But they're going to make you, when you buy VT, they're going to suggest GameStop and AMC.
Right, but he's already got it.
No, not Blockbuster. You can't buy that anymore.
No.
But they're going to tell you, well, you could buy Blockbuster. It's not publicly traded. No, I mean, the thing is, yeah, okay. I'm trying to be funny here. I get it. But yeah, right,
no, I just say buy VT.
Sure.
Just buy VT when you get home. Or here's the deal. Use Dad's address. I don't know.
Well,
Dad can set it up. Just send him a check.
Yeah. Okay. That's a simpler method. I just trying to do it internet. I mean, you saw that Vanguard just recently decided that their big foray into China is not going to happen as they had thought.
Not the same way, but they're still going to offer some investments, some Vanguard funds to the Chinese. Yeah. Yes, but they didn't go into the deal with the Ant Group.
Correct. Yeah. Well, Ant may get squashed by the government. Yeah. No pun intended.
They're going to start working with the Centipede Group soon, though.
A lot of legs there somewhere. It's got
Spider
legs.
Group. No, that's S&P. 855-935-TALK is our phone number. And shall we start? No, we shouldn't, because we got the bottom of the hour break. So we got to wait. We got to take the call afterwards. We can't do that.
Yeah, we'll talk to you in just a couple
minutes.
You
were looking at me like, do it right now, but we don't have time.
I always look at you that way. That's just how I look at you. It's great sense of affection and respect.
But I have no problem buying VT through Robinhood. As a matter of fact, you know how I played with Robinhood once with a couple of bucks? And I bought a stupid stock.
You love all the
and I played the game. And then I think I sold for like $20, and I just put that in an index fund. I think I put it in VT. And they haven't bothered me. So
you still have the account open?
I think I have a $20 account. I think I have a $20 account at Robinhood and VT. It should probably close that.
In time, that'll be $21. So stay tuned.
There you go.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
Reality radio for a really great future. We're talking real money.
Welcome to the show again, all of you. Those of you just drifted over and went, wait a minute, what is this? Oh, it's a couple of guys talking about money. You might like it. Stick around for a minute. We're not going to lie to you like some of these other people do. We might hit our mic stands.
Unvarnished truth.
But we don't lie.
Painful as it is.
And it is painful sometimes. Really, for all of you who think there's some magic formula to get rich quickly, this is a painful program, but necessary. This should be part of your 12-step program to stop speculating. Ooh, we should do that. Would. All right.
Our friend Mark Hebner already did the 12-step thing.
Okay. 855-935-TALK is our phone number, 855-935-8255. Gary, welcome to Talking Real Money.
Hi, Gary.
Hey, thanks for taking my call. I want to retire at the end of the year, and Right now, my portfolio is a little bit messed up. I'd like to go to like a 20% cash and then like thinking about an 80% target date retirement fund. What are your thoughts on that?
Why so much cash?
I don't know. It's I'll be 67, and I figure 20% would be, probably a pretty fair figure.
Here's the thing. Yeah, about cash. Okay, so which target date are you thinking about? Like a target date 2021 fund?
No, 2020 or 2025.
I've been looking through like 2025 through like about 2055.
Okay.
And it seems like the rates are all pretty consistent between about 9 to 11%.
Can I step in?
Right.
May I step in for a moment? All right. You cannot look at past returns and think of it. Here's the problem. Most of us are trained to think of interest rates like a bank pays out. Mutual funds don't pay regular interest. They don't. They make money when the market rises, and they lose money when the market falls. And then what we're looking for over time is a nice average return, bearing in mind all of those ups and downs. We want to smooth those things out. The shorter the maturity.
Yeah, right.
2055 is going to be aggressive.
That's going to be 80, 90% in stocks probably, whereas the 2021 is going to be closer to half of the money in stocks, half in bonds.
All right, it's 2020, 2025. There is no 2021.
Sure, there's a 2021.
No, there isn't.
Fund.
No,
why not?
There are 20 because they're every 5-year increments.
What? I didn't even know that. I'm learning something.
Oh, you just
today.
learned. No, they're
every year.
No, there's just 5 years.
All right, setting that aside just for a moment. All right, but here's the thing, Gary. I do not suggest, nor do I use for my clients, cash as an asset class.
Nope.
I really believe you should have all your money in stocks or bonds or similar. Why? Well, the bonds are there for the base, right? So if the stocks go down, you can still draw from the bonds to pay yourself in retirement. And the stocks are there to give you some lift. So I would just pick the appropriate risk to return ratio fund for yourself, which is 2055 is going to be, wow. That's going to be
2055. Get this, 2055 is 90-10.
Yeah, I mean, that's a very aggressive portfolio. So there you got to expect a loss somewhere along the way of 40% of your principal. That's a lot for somebody who's retiring. So maybe Don's right at 2020 or 2025 or 2030, something like that.
Here's the thing, Gary. Here's what I want you to do. I want you to go to talkingrealmoney.com. Take the risk quiz, RISQUIZ, risk quiz, and find out what your risk tolerance is. We're going to tell you what the portfolio allocation should be after that. And at the most aggressive you want to be probably getting ready to retire is a 60-40. 60% stocks, 40% bonds. And that's going to be the 2025 or the 2030 target date fund, probably, somewhere around there. Mm-hmm. So you don't want to be too crazy aggressive. You don't want to be too ridiculously conservative. And as Tom said, cash, any money you hold in cash is money on which you are willing to guarantee a loss. You're guaranteed to lose money to inflation.
It feels good, but it's not going to pay the bills into the future very far.
Yeah, it doesn't do anything good for you. So that's what we do. Get started the right way. You need a plan first. You need to know what you want this money to do for you. How much do you need it to make for you? And then how much risk can you take in doing so? We are always trying to rush to the final answer when we need to take it step by step.
Tom and Don are talking real money.
Set your course for a great future with a free copy of our 60-page Better Retirement Guidebook at vestory.com, vestory.com.
For your real life and real future, Tom and Don are talking real money.
Hey, welcome back to the show. I'm Don. That's Tom. 855-935-TALK is our phone number, 855-935-8255. It's kind of interesting to look at the differences between the various target date funds. They differ by about 5% in their allocations.
And target date fund, the idea here is they're building the portfolio according to your retirement date, roughly.
Roughly.
And they assume your risk tolerance is similar to other people. That's the struggle I have with them. But they're a simple one-stop solution. It's about 2 out of 3 retirement dollars now are in target date funds. Don looked this up very kindly. The 2020 is 52% in stocks, 48% in bonds, and the 2025 is 60-40, which is kind of a moderate portfolio. So interesting.
Actually, technically, it's 59-41.
Okay, pardon me.
Sorry, just want to be technical. 855-935-TALK. That's the number to call the show when we're live. It's also the number to call 24 hours a day, 7 days a week if you listen to the podcast and leave us a question. Michelle, you're next. Welcome to Talking Real Money.
Hi, guys. Thanks for taking my call.
We're glad you called.
Our
What's
pleasure.
up?
I have a question for you about working with companies like a Northwestern Mutual kind of company where they are charging a fee up front. If it's a long-term investment, I think it's around a 4% fee. And then that allows an annual fee to be lower, like a 1.3%, I believe. Or then there's the other option where it's a shorter-term investment and there's a lower upfront fee, but you're paying more on an annual basis.
This is a mutual fund. This sounds like a mutual fund, Michelle. And okay. Most insurance agents or insurance financial advisors sell both insurance products and loaded mutual funds. What you're getting, it sounds to me like you're getting the difference between an A share and a C share. The A share has an upfront commission and a slightly lower fee. The C shares have no upfront commission, but a very high annual fee.
The expense ratio, how much they charge you every year for the operation of that fund.
Now, let me tell you a little, because you just said 4% upfront and 1.3% a year. I'm guessing the C shares are over 2% a year, right?
Yes, in that range.
Okay, you ready? This is fascinating. If you were to go to Vanguard and get into, hold on, let me put the right symbol in there. I just typed wrong because I'm a terrible typist. If you went into the Vanguard Total World Stock Fund, Total World Stock Index Fund, owns 8,000, 9,000 different stocks.
8,800 securities.
You would pay no front commission to get into that fund.
0.
And you would pay 0.1% per year.
Okay. Are there fees
now, which
when
fund?
you sell the stock?
Nope.
None.
None.
And this is why, by the way, we don't recommend you use insurance people for investments.
Right.
Okay.
Insurance.
Wait, let me ask you a question.
Buy insurance from them, that's okay, but not for investing.
Are they really nice?
Yeah.
Is this person a really nice person?
He is a really nice person, yeah.
Yeah, see, they're always so nice. And he's somebody you know from somewhere or a family member or something. They're always super nice. I would never, ever, ever buy any financial product from a commission salesperson, ever, when there are so many great products out there, Michelle, that have no fee going in, no fee going out, and no big fee along the way because you don't have a salesperson to pay. Those high fees are not there for your benefit. They're there for the insurance company's benefit and the mutual fund company's benefit. Does that make sense?
It does, yes. It makes me sad.
Go to.
It does make sense.
I'm sorry. But this is money. This is money. This can't be personal.
Your money.
Yeah, this
your money.
Truly is business, Michelle. If you want to build a great portfolio, it's so easy. This is why you don't need these people. It's so easy to do it on your own. Go to talkingrealmoney.com, our website. Take the risk quiz. Find out what your risk tolerance is. Then scroll down the page and you'll see 3 funds from 3 families. Set up an account with either Vanguard, Fidelity, or Schwab and use those 3 funds to build a simple, massively diversified portfolio that will cost less than 0.1% a year.
Wow.
Thank you so much. Thanks for calling. Go do it.
Yep. Thank you.
Take care. Thank you. 855.
And by the way, somebody, go ahead.
No,
number 855-935-TALK.
We don't actually need to give it.
Yesterday that we also do not recommend you go into bank lobbies and use the person in the bank lobby for your investments either, because generally they're commissioned salespeople.
And they have no special skill sets. They don't. They
No, they do. You're wrong.
What? They're salespeople.
They're very nice people.
And they're often nice. Very good salespeople. And how do I know that? I just want to share real quickly. I was 26 years old. Dean Witter hired me with no financial experience whatsoever. Why? Because I was a very nice person and a good salesperson.
And I've been meaning to ask you about the Blockbuster stock you got me into. I still have the certificate here. I don't know what to do with it.
Public storage at 8%. I sold a lot of that. Kirk, you're up next. Welcome to Talking Real Money.
Hey, Kirk.
Hi, Tom and Don. How are you?
We're well. Thanks for calling.
Good. Say, I have a combination of retirement, 401k, traditional Roth IRA, pension, and a taxable account. Does it make sense to do the balance between keeping maybe the retirement accounts more aggressive and then using the taxable account for your bonds to kind of reduce the volatility?
Actually, the other way around would be better, because the taxable, the tax rate when you take that out is only going to be the 15% long-term capital gains. When you take money out of the 401k into traditional IRA, that will be taxed at whatever your income tax rate is, which is generally higher. Therefore, if you're going to do this as a combined portfolio, you put the bonds that are tax inefficient anyway, you put those in the traditional and the 401k, you put more of the stocks in the taxable portion of the portfolio.
Make sense?
I see. Okay. Yeah, I'm not planning on retiring for about 7 years, so it's just
doesn't matter, because it's the tax treatment down the road. We always tell people when they say, "Oh, I've maxed out my IRA, I've maxed out my Roth, and what should I do with the money?" If you buy growth-oriented products like ETFs outside of an IRA or a Roth, you still get a tax advantage, a huge tax advantage, because remember, ETFs, except for their dividends, they're tax deferred until you sell them. And then when you sell them, as opposed to an IRA, which is taxed as ordinary income, that's taxed as a capital gain, which currently is at a much lower rate.
Currently. There's a lot of discussion. And, of course, in the great state of Washington, we may have a capital gains tax to pay next year, too. But that would be above $250 if the current bill passed. So I think that makes a lot of sense. And, by the way, doing the combined portfolio makes a lot of sense for the reasons of taxation that you just mentioned. Yeah,
thanks for the call. Good luck. And remember, call us 24 hours a day, 7 days a week at 855-935-TALK, 855-935-8255. And please go check out the podcast. Lots of additional information on whatever major podcast service you listen to.
Tom and Don are talking real money.
A second opinion could save your life either physically or fiscally. Let one of our Vestory advisors help you save your future at Vestory.com, Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
And we try to help everybody on our show and podcast, but we really can't get into the complex stuff, the detailed stuff, like going through your whole portfolio, or trying to help you get started on a plan, or really just big picture items. You got a lot of questions? We want to help, and we can help you as a client. We'll do it. We'll help you all the time, but we'll also help you anyway. We help everybody. We want everybody to get a leg up on investing. So if you want some help, say you need up to an hour of help, we're going to give it to you for free with no cost, no obligation, and better yet, no high-pressure sales pitch. Just go to Vestory.com, scroll down, set up an appointment, and we'll meet with you. Just go to Vestory.com.
We hope you realize that the information information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestory, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. That should keep the lawyers happy.